MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard, and welcome back to Canada after a trip to Oxford.
It's nice to be back, and just got off the plane a few hours ago, so it's all fresh in my mind, but it's a little bit confusing. And also, I stopped in Amsterdam on the way back and met with one of the leading economists in the non-orthodox world for a few hours, too, so there's a tremendous amount of new information that I got from these people, so it was pretty great.
You also managed to learn about where quantitative easing came from, the term and its use. Could you maybe tell us about that? And is that part of the Oxford trip? Yeah.
So the seminar in Oxford was put on by Richard Werner, who's an economist based at Southampton University in England and also in China at Fudan, and he's written several books. And he was working in Tokyo with one of the big brokerage firms during the 90s. And that's when the bubble had burst in Japan. 1989 was the peak, and the economy started to go down, and he was advising the government there, and he recommended that they do quantitative easing, and he coined the term quantitative easing. What he was suggesting was that the central bankers put money back into the economy, but it was really important how they did it. And he explained the correct way for them to do it, but they didn't listen to him at that time. So it wasn't until 10 years later, in 2001, that they started actually doing quantitative easing in Japan. And then a few years later in the U.S., the Federal Reserve picked it up, and they called it quantitative easing, although I don't think he was involved in advising them. By then it was fairly well known. Bernanke and some of the people had been back and forth to Japan to learn what the Japanese did. The Japanese basically did everything wrong, and so they had this. After the bubble burst, they basically have been in 20 years of deflation and a very slow economy. So, but Werner had a proposal that would have worked, but it was just too radical for them at the time, I guess.
Well, you still have Japan and Switzerland where they have negative interest rates.
Yeah, it's interesting. Germany as well, and so one of the things that, of course, out of my book about the housing bubble in Canada, now I'm getting interested in, after this seminar, I'm getting interested in looking at housing bubbles in Australia. And I do talk about that in my book, but Japan, of course, the bubble was a long time ago now, 28 years ago. And Germany, which has not had a bubble. And so the conventional wisdom is that, interest rates, if you put the interest rates too low, like the Federal Reserve has done and Bank of Canada perhaps has been accused of doing, then you create the bubble, the housing bubble, and so it's the central bank's fault. And of course, that's completely wrong because Werner has shown it. He's done some pretty sophisticated statistical analysis that he shared with us. But you don't even have to do that. Just think about it. Germany has got negative interest rates, and Japan has had the lowest interest rates in the world for probably 20 years, much lower than Canada ever got to. And neither of those countries has a bubble in housing. And it hasn't. In Japan, they had a bubble, but it's over by 1989. And in Germany, they never had a bubble. So it's obviously not interest rates. And it's actually the main tool that the central banks use is interest rates. And it actually does not have any impact. So all the central bankers in the world are running around pulling that lever that's labeled interest rates, and it's not really connected to anything in the economy.
So what is it that causes the bubbles and then bursts the bubbles?
So the theory is called the credit creation theory, and what it is when credit is created, and this is done through the banking system, either through the central banks or through the banking system, but most of the time it's through the commercial banks. And that credit, or you could think of it as new loans, and most of it's mortgages, so think of it as the new mortgages, goes into the system, and it can be used for good and it can be used for bad. So, for example, if it's used for, as they did in Japan in the 80s, if the people that take out the new credit and the new loans, and in the case of Japan, it was mostly corporations, not so much households like we have in Canada today. And if they use that money to speculate, and they did in commercial real estate and all kinds of stuff, the stock market, they went around, they borrowed money and bought all shares in each other, kind of they called the shareholder cross-holding thing that they were doing, then that creates an asset bubble. And of course, none of that activity is actually in the GDP. So the rule for the GDP is it's supposed to be value-added activity in the economy. And buying and selling, plots of land or houses or stocks on the stock market, there's no value added there, so it doesn't get included in the GDP. So of course, what happened was all of this new credit going into the Japanese market created this massive asset bubble. And of course, that's exactly what's been happening in Canada the last 15 years as well. So instead of it going to the GDP, it goes into creating an asset bubble. But it's got nothing to do with interest rates. It's got to do with the quantity of credit that's made available. And it's usually done through the banking system, although it could be done directly by the central bank. But that's there's a lot of concern about central banks, just printing money and putting it into the market. People are worried about that creating inflation, and it could create inflation. So you have to be careful how you do it. So the quantitative easing, to get back to the term quantitative easing, the quantitative easing that was recommended by Werner was supposed to be directed through the banks, but it was supposed to be carefully done so that it was designed only to go into GDP-related investment and transactions that would actually help the productive capacity of the economy, not just into inflate asset bubbles. But unfortunately, the trend has been since the time of Thatcher and Reagan that it's kind of a world where we believe that the free markets will be better allocators than what anybody in the central bank or the government could choose. So we just throw the money into the market and hope that it does something good. But in the past in Japan and today in Canada, in Australia as well, it's mostly gone into asset bubbles, which is going to create a huge problem when the inevitable bursting of the bubble comes along.
We'll have more with Hilliard MacBeth right after the break.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the Pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the Pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, you said that part of the seminar in Oxford included talking about the old economics versus the new economics. What's the battle about, and who's the best?
So the mainstream economics, or the neoclassical economics as it's called, is based on this very theoretical, very abstract idea that markets are perfect, there's always equilibrium, and if the equilibrium is disturbed, it somehow magically goes right back to equilibrium right away. There's no banks in the theory. There's no money, and money is completely ignored in the theory. There's no debt in the theory. So it's basically this very, very odd construct. And the So basically what it is the economists sit around and of course, it's not their fault in the sense that they're some of the smartest people in the world. They're economists and they're extremely good at mathematics and they're extremely good at this type of logic that they use. But unfortunately, it's not connected to the real world. So the attempt by Werner and another fellow named Steve Keen is to look at the way the world really works and try and construct economic models that reflect the reality of the world rather than just a theoretical construct that the neoclassical world. And what the really odd thing is, there's no banks, there's no money, there's no debt in the neoclassical model, but the econometric model that the central banks use is based on that neoclassical general equilibrium model. So it's really quite bizarre. So we spent quite a bit of time in the seminar looking at those different things, and I think people are shocked when they hear that that the most widely used economic model doesn't include debt and banking. I mean, there's nothing more real in our lives than debt and credit, and of course it's what gets us. It gives us the illusion that we get rich for a while, and then of course that's the boom, and then of course it also can be very devastating if there's a downturn comes and people lose their homes because of foreclosure and have to declare personal bankruptcy because they've run up their credit cards too high, and it's going to happen to a lot of people in Canada and Australia and other countries. Unfortunately, the mainstream economic model doesn't count any of that. The main flaw, the reason that they get so off track with banking and the way they can ignore it is they assume that banks are intermediaries only, and so basically, and people will recognize this, I think. They say that the banks raise deposits from the public, and then they take that money, take a little cut as their fee, and then they lend it out to people that need money to borrow. So they're kind of just the go-between, which is totally wrong, because for one thing, nobody really has money sitting. I mean, where would that money come from? It would have to be in a box buried in the backyard or something like that, and people just don't have money like that. 97% of all the money in our system, in our banking system, is in the form of bank deposits that were created when somebody took out a loan. And it's usually a mortgage loan. That's the biggest chunk of it. It's about 65% of all the money, all the growth and all the money since 1960 has been estimated to have been in the form of loans taken out by households, almost entirely for housing as mortgages, because you don't really get to borrow that much from the bank unless you have a real estate collateral to offer to them. So that's where the money really comes from. But there's this fiction that somehow there's these deposits sitting around. These rich people have this money. I don't know where they have it in cash or they have it sitting hidden away in their safety deposit box, and they deposit it one day, and then the bank takes it and then relends it, which is, unfortunately, it's still taught in the textbooks in the basic economics, and even as far up as graduate school. So one of the things that we talked about at the seminar was how wrong that is. So actually what really happens is when you sign that mortgage document to take out a new loan, that's brand new money that's been created, and that's called the credit creation, the act of credit creation. So basically money appears out of thin air, and that is why the role of the banks and what they lend that money for, whether it be for a house or to a business to grow their business, the decision they make are so important. And we've set up a system of rules in Canada, Australia, and elsewhere that basically is designed so that the bankers are incentivized to make mostly housing loans because it's safe for them, it's profitable, and it's much easier than trying to figure out, should we lend money to this business or that business, and is it safe, and what kind of business do they have, and how do we protect ourselves from the risk and all that. The banks have pretty much all gone away from that, and so here we are. Now there are some exceptions, and we talked quite a bit about Germany, and Germany's the big exception.
What makes Germany exceptional?
So what Professor Werner says, and he's got research to back it up, is the main thing is the size of the bank. So in Germany, they've got over 1,500 basically tiny banks. They call them community banks. There's various terms for them. Sparkassen is one where it would be a non-profit bank in a small town. Usually the mayor and a bunch of people in the town are as part of the management of the bank, and that's how you get your loans. And those small businesses small banks tend to lend to small businesses. The larger the bank, the more likely they are to make large loans to large businesses or to make loans to something safe like housing, which, of course, in Canada, they're protected by the CMHC insurance. But in Germany, they have over 1,500 of these. So compare this. In Germany, you've got these tiny, tiny non-profit banks, over 1,500 of them. In Canada, you've got less than 5 big banks that control 90% of the market. So in Germany, those 1,500 tiny not-for-profit banks do 60% of all the lending. And that's why in Germany you have these wonderful small and medium-sized enterprises that export highly value-added goods all over the world. They're the leading exporter in the world, even bigger than China in terms of exports, and very high-quality products because they're supported by a small local bank that's willing to take a risk. And the reason that the small banks, as it was explained, are willing to take a risk is because they know the people. So it isn't like you go to Calgary or Edmonton and you apply for a loan with the bank. It goes to Toronto in the credit department, and they don't know the people. So they just go by a formula, whatever is written on the application. In Germany, in the tiny small banks, they would know all of the people that are involved. They would know their families. They would know the history, and so they can judge whether they're a good risk or not. So that's the example of a different way of doing it, and it's why in countries like Australia and Canada, where we don't have that system, we're falling way behind in terms of the support of small and medium-sized businesses. We don't have any champions in that sector that are able to export all over the world high-quality added technology type products. At least we must have some, but we don't have very many compared to a country like Germany.
So, in other words, we need a lot more credit unions.
Well, I don't know if credit unions So this is the research. So this is the next inquiry, and I don't know. I haven't started yet, but obviously we have to look at several countries all over the world and get an idea of, does anybody actually direct the credit creation into the forces of good or the forces of bad? If you like, I use a non-technical term, but obviously Germany it looks like we shouldn't jump to conclusions, but it certainly looks like they've figured something out. Now, there is a bit of a cloud on the horizon for Germany because the European Central Bank, who's now taken over of course, the currency is now the euro. They are pushing to get rid of these small community banks. They want a bunch of mergers and they want bigger banks. It's easier to supervise them, for one thing. But there haven't been any failures of those tiny, small community banks. They never get into trouble because they never really do anything that risky, right? They basically they don't get involved in big loans, and they don't go even to the next town to make a loan. They stick very close to their home where they know what's going on. So it's there's a lot of pressure in the world, and you know this. Like, you look at any business, like look at the technology business, for instance. It starts out a whole bunch of little companies, and the next thing you know, there's a Google and an Amazon and a Facebook, and they've gobbled up all the other startup companies, and so then that's where you get into trouble. And in the banking system especially, it's quite dangerous because then the very large organizations, the risk is that they'll lose touch with but in the case of the credit unions, I'm not 100% sure. I have to find out if they are. My sense is that we'd have to check on that as to whether they actually make loans to small businesses or not, or whether they're doing also just personal finance like household mortgages and auto loans and credit cards. I don't know. I think they might also be suffering from being in the shadow of the really big banks. It's really important that, in Canada, 90% of probably all the lending to the households is done by those top 5 banks. So it's hard for the credit unions to do very much because the competition is so difficult. That's not the case in Germany. These small banks control more than half of the market, so they've got a lot more clout in the overall system there.
We'll have more with Hilliard MacBeth right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and planned for Canada this summer. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol AESDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, so after this conference in Oxford, what do you think is going to happen with interest rates, and what should happen with interest rates according to the discussions there?
Well, that's a really good question. What the research shows that the professor has done is that interest rates are a lagging indicator, not a leading indicator. And apparently, the organization in the U.S. that measures the business cycle shows it as interest rates as a lagging indicator. So instead of the central banks being out there, lowering interest rates and causing the economy to grow faster, and raising interest rates and causing it to slow down, what actually happens is the economy starts growing faster, and then interest rates are brought along with a lag of a few months. So if the economy stays strong, like it is in the U.S. right now, then interest rates will keep climbing, and I think that's in the short run what's going to happen. We didn't talk about that at the seminar in Oxford, but based on the empirical research that he's done and others have done, that would be most likely. So the interest rates will not go down. They will not start falling again until the next recession comes. Now, it has been 9 years since the last recession, so we're a lot closer to the next recession than we are to the last recession. And in Canada, I think you and I have talked before about this, the last recession in 2009 was quite mild, and the U.S. had a very severe recession, but we had a very mild recession, the difference being the housing market held up in Canada, but it didn't hold up in the U.S. So the next recession is going to be tougher for Canada than it was last time. Same with Australia. Australia didn't even have a recession in 2009, and so Australia basically hasn't had a recession for 20 or 25 years. So, and Canada's only had one quite mild recession. So the next recession is going to be more difficult for those two countries, and it's because both Canada and Australia were using credit creation through the banking system to go into the housing market, and rising housing values allowed the credit creation to continue for many, many years, but eventually you run out of room to push that money into that asset bubble. Once the recession starts, the interest rates will come down. They'll probably come down quite quickly. And, of course, the Federal Reserve and the Bank of Canada, the Bank of England will announce that they're lowering interest rates, but really all they're doing is following the trend. They're not leading the trend.
Bob Hoy has mentioned that he said they're really followers, and then it's almost like a snake eating its tail. They upped interest rates, so they're leading this indicator, but they're just reacting to what's going on around the planet. They
are, and especially you could argue, for example, that the Federal Reserve in the U.S. has the ability to be the leading with interest rates, but they never do it. In my career, going back to the 70s. The only time, and Bob Hoy, I think, goes back even further than I do. The only time I can remember when it looked like maybe the Federal Reserve was leading a little bit was when Volcker was the chair of the Federal Reserve, and he raised his rates up as high as 18-19%. But even in that case, he was responding to inflation, which had been over 10% a year for 3 or 4 years in a row. So you could argue also that he was just reacting rather than leading. So it would be very, very unusual for any central bank to raise interest rates to the point where they caused a recession before the recession, the natural cycle of recession would occur. That's what everybody thinks they do, but I've never seen it, and I'd be surprised if it ever happens, because they would be, even though central banks are supposed to be independent from the government, they're not that independent that they can run around and trigger recessions by raising interest rates. But that's what they would have to do to choke off an asset bubble. They would actually have to raise interest rates so high that people would. So that's not a very good way of doing it. The better way of doing it is what they call macroprudential policies, and that's the proper way to do it. For instance, in Germany, the normal down payment when you buy a house is 40%. So you have to show up with 40% down payment. You get a loan for the other 60%, and that's one of the reasons they don't have a housing bubble there. And it's also one of the reasons that only 40% of the people in Germany own their own homes. The other people are renters. So it's so the rules around down payments and mortgage insurance and all that stuff are way more important than what the level of the interest rate is, and those are the more important tools. And also, and this is something that is kind of a touchy area, is who directs the banks when they decide whether they're going to support asset bubbles like housing, or whether they're going to put that loan into the into GDP related investment activity. There's all kinds of opportunities with small and medium enterprise, with infrastructure, with green type new projects, all kinds of new projects. But the banks generally don't get involved in that. It's people that are trying to raise money for those things, they have to go to the stock market or to private equity or that kind of things. They don't really find the banks very receptive. So it's a big change. When 50 years ago the banks were involved in that sort of thing. Now they've basically drifted away from it. So how do we get them reoriented so we can push them in the right direction? That's a big question. I don't know what the answer to that one is. We should probably study Germany and see what they've done, and try to figure out how we can take some of the best what they do and apply it here in Canada and also in Australia and other countries like that.
Is there any will to do that?
I don't. They say it's interesting. There's that saying, never waste a crisis, and unfortunately it's true. And what they mean with never waste a good crisis, they mean what's behind that is the fact that you can almost never make substantial, serious change, except in the immediate aftermath of a major crisis, like a financial crisis, like the bubble bursts, and then people are willing to examine the ways they've been doing things and maybe make a change. And so you almost kind of have to wait until the current system causes a massive screw up, and then you can say, okay, that's not working, let's try something else, right? So, but look at 2009 in the U.S. I'm still shocked at this. It's 9 years later, and I don't think they really changed very much. The only thing that seems to have changed is the big banks in the U.S. control a larger percentage of the market than they did. Remember that whole discussion about too big to fail? Well, they're bigger now, so they're even more too big to fail than they were before. So it's we didn't really get basic change out of that. So there's no guarantee that a crisis opens up the opportunity to make significant change, but it is a better opportunity than when people think things are going along fine and they don't really want to be bothered with it. It's really hard to get their attention. So we have to wait for the next crisis and then hopefully try and find a way to convince people that it would be a good thing to change the system so that not all of the new bank credit that's the new money that's created through bank loans and mortgage loans, that money can be directed into something more productive than just speculating in asset bubbles.
Hilliard, thank you so much for chatting with us.
Thank you for listening.
My guest has been Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, macbethgroup.com. You're listening to HowStreet.com radio. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests, like Hilliard, can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.